the domestic inflation. CPI headline inflation declined for the 8th consecutive month to a 77-month low of 2.1% in June. This was driven primarily by a sharp decline in food inflation, led by improved agricultural activity and various supply-side measures. Food inflation recorded its first negative print since February 2019. It was negative 0.2% in June. Double-digit deflation in vegetables and pulses drove this contraction. High-frequency price indicators signal a continuation of the lower price momentum in fruit prices to July, the last month as well. Fuel group inflation moderated over 2 successive months to record 2.6% in June. Core inflation, on the other hand, which remained within a narrow range of 4.1 to 4.2% during February to May this year, increased slightly to 4.4% in June, partly driven by continued increase in gold prices. The inflation outlook for 2025-26 has become more benign than expected in June. Large favorable base effects combined with steady progress of the southwest monsoon, healthy kharif sowing, adequate reservoir levels, and comfortable buffer stocks of food grains have contributed to this moderation. CPI inflation, however, is likely to edge up above 4% in Q4 of this year and beyond, as unfavorable base effects and demand-side factors from policy actions that we took a little while ago, a few months ago, come into play. Barring any major negative shock to input prices, core inflation is likely to remain moderately above 4% during the year. Weather-related shocks pose risks to inflation outlook. Considering all these factors, CPI inflation for the current year 2025-26 is now projected at 3.1%. This is down from 3.7% that we had earlier projected in June, with Q2 at 2.1%, Q3 at 3.1%, and Q4 at 4.4%. CPI inflation for Q1 next year, 2026-27, is projected at 4.9%. The risks are evenly balanced.